Welcome to Focus on Fuels, brought to you by StoneX. Your hosts are Trevor McClanahan, Risk Manager, and Alex Fodes, Director of Market Strategy from the StoneX Energy Desk. Alex and Trevor help fleet managers, fuel buyers, and energy procurement specialists gain control of fuel costs, boost margins, and keep their businesses competitive. Join them for another deep dive into the volatile energy markets.
Remember that the trading of derivatives such as futures, options, and over-the-counter products or swaps may not be suitable for all investors. Derivatives trading involves substantial risk of loss. Past results are not necessarily indicative of future results.
Welcome back, everybody. I'm Alex Fodes, and I'm here with my co-host, Trevor McClanahan. How's it going, Trevor?
Doing good.
So today, it's the turn of the year, so we thought it'd be fit to just kind of do an overview about what factors are affecting the market now and maybe what could be affecting the market in 2025.
Yeah, I know we talked a lot last time about having on a renewable fuels focus on the next podcast, but talked to the renewable fuels team, and they basically told us there is absolutely no changes, no clarity on what's going to happen with the new administration. So we deferred that, and we're just going to talk a little bit more about just the market update in general here.
Yeah, and I think first off, the market has been kind of moving higher after the turn of the year. We've moved above some of the long-term moving averages, which had been kind of, honestly, the market had been relatively boring going into the end of the year, kind of in a wait-and-see mode. And we've seen actually, as of yesterday, open interest was at its highest level since March of 2022 as of yesterday. So that's kind of telling that investors and traders are getting back into the market. They think they have somewhat more of a picture on factors that are going to be affecting prices. And so far, it's somewhat bullish. One of the headlines that's really been driving things has been there's been a lot more visibility with regards to sanctions with the Trump administration coming in, one of which was a recent adding of Costco Shipping Company, which is one of the largest shipping companies in the world, to a military blacklist. This is a Chinese company, and essentially they were put on this blacklist with regards to their dealings in Iranian crude oil movement. In addition to that, there's been some headlines with regards to ports in the Shandong region in China, which is a huge refinery complex area, and they're under more scrutiny for kind of accepting Iranian crude oil. So you can already see kind of the pressure being tamped up on Iranian crude oil transportation. And that is one factor that I think we should continue to have eyes on. However, there's a lot of questions of, how much we can do or how much the administration wants to do and can do in slowing the flows of Iranian crude. If you look back to Trump's first term, you could see Iranian crude oil exports had dropped substantially. They were averaging around 300,000 barrels per day after the enforcement of sanctions. Right now, they're about 1.5 million barrels per day. And the way they've been doing this is a lot of ship-to-ship transfers off the coast of Malaysia. And so China can basically purchase this crude and be like, hey, we're not buying Iranian crude because it's coming from Malaysia. But when the numbers don't add up, it's kind of obvious of these barrels are not coming from Malaysia crude oil production, since their total production, I believe, is under 400,000 barrels per day.
Yeah, I'm starting to think that the more I dive into that subject, I think it's going to be a little bit of a choice from China, whether or not they're going to police that to some degree. And they might be the ones that really are the difference maker on the relationship with the U.S. and the West in general and how closely they want to be tied to it. So I think when Trump comes into office, that relationship between him and China, it already looks a little grim, right? But if they're trying to impress Trump in some way, maybe that, not buying those Iranian barrels is one, good act of faith there that might actually try to turn the tides a little bit. And that will, I think that's going to be, I'm starting to think that that's going to be more of the catalyst there than really even the U.S. making some sort of military stance against Iran on actually exporting those barrels. I think it's really going to come down to whether or not China is going to try to improve relations with the U.S. and try to do something in the light of that nature there.
Yeah, I think it seems that, something militarily would be a very risky option. And I don't think that's likely with regards to stopping flows of Iranian barrels. I don't think the amount of resources that would have to go into that would be just a large amount, and it would really flare up tensions even more than need be. So sanctions are already in place. So I agree with you there. China is going to be, the one. Basically, Trump is trying to approach the buyers of this crude because he knows he can't totally stop the flow of it, and so he's going to try and minimize the amount of buyers. But there's always going to be somebody looking for a cheap barrel somewhere. So India's also been a big purchaser of Russian crude oil. So I think, there's going to be outlets for Iranian crude oil. So honestly, my opinions of how much Iranian crude getting to the market is kind of changing as I see more and more evidence, but we won't really know that quantity till later in this year. Another kind of topic that some people are discussing has been tariffs placed on Canadian crude oil. Trump threatened that we would be placing tariffs on Canadian crude oil imports, which would be a substantial amount for Midwestern refineries. There might be more just kind of regional changes if this were to occur. I think it's more of a posturing and not really going to actually follow through with it. But if it did follow through, we'd see a little bit more high-priced refined products in the Midwest and Chicago specifically, because they are large buyers of Canadian crude. But again, I think that's just more of a posturing thing. But recently, what's driven a lot of this higher price action is it's super cold in Kansas City. We just got a foot of snow last week, and our road crews are still struggling to clean it off the streets. We seem like we're a bunch of Texans in here with our road clearing, but the cold weather has just put kind of a bump in the market. Heating oil specifically in the Middle Atlantic and the East Coast, where they primarily use heating oil for their homes, that's been pumping up heating oil, propane, and crude's just getting brought along as well. So I think there's an uptick in heating fuel demand thus far, and that's been a big driver. What about you? What do you think of? You've been kind of focused on what the weather's expected to look like and what kind of effects that might have on the market.
Yeah, that's been a huge topic for my customer base here in the last week, especially. We're starting to see pretty much the entire country see extremely low basis values on ULSD. And that whole distillate pool is kind of it's a little bit out of whack right now due to the fact that, like you just alluded to, the home heating oil demand that's hitting the Northeast right now is extremely high. The forecast for the Northeast right now is still expected to be cold for the next couple of weeks. Back into the month is supposed to warm up some. So just realize this, the rest of the country will probably, the NYMEX heating oil contract is based out of the New York harbor. So when there's a deficit happening within that region, within the harbor itself, you're going to see that contract really get bid up. That's going to affect two things. That's going to affect the basis within the country, the entire country, outside of the Gulf Coast and the Northeast. And then you're going to also see time spreads start to get very inverted. And that's been a really big focus point. So we've been trying to capitalize on that with storage hedging within the Midwest especially. And then the PNW is also seeing some pretty weak basis as well. So we're leveraging that substantially. But to be honest, those are my two focus points as far as customer base goes. So you'll see that in west of the Rockies as well, weak basis values. So those aren't the only two. Those are just happen to be where my customer base is. So massive discounts right now in comparison to the NYMEX in those two regions. So I don't expect that to last much longer. I think we might get through the end of the month with those discounts in place on basis. So keep in mind when you're doing a storage hedge in general or a storage play in general, basis is irrelevant without a NYMEX short position on in congruence with your storage levels, your physical storage levels. So that's what we're talking about here. So flat price, it may move higher in comparison, but at the same time, what we expect here, we really think that the gap is going to close between New York Harbor heating oil or the NYMEX ULSD contract and local regional rack prices. And we think that in the Midwest and then the PNW as well. So we think that gap will close within probably sometime in February. And again, it's just a weather play essentially. Northeast is going to get warm up a little bit. They're going to be able to recover their storage levels in that region on diesel, the distillate pool. And then, it's going to look a little bit more similar to what the rest of the country looks like. So that's been a big topic. We're taking advantage of that as much as possible, filling up inventories all over those two regions and staying as full as possible and putting the hedge on. The other big thing is, as I said, is the time spread. So we're in a very inverted market right now, meaning that the further out months are discounted in comparison to the front month on the heating oil contract. What the reasoning on that is just the time spread is a measure of what inventories look like in the New York harbor. So right now we're at a deficit, and that's going to cause an inverted market. When supply recovers, we'll go back into a carry likely at some point, maybe February or March.
I think one thing to pay attention to here, or something that's actually just, maybe it's not really intuitive of inverted versus carry market, I think, is, a lot of people look at curve structures. And when we throw around this terminology, this is, a lot of people kind of have different names for the same thing. So bear with us. But Trevor did a good job of kind of spelling out what that inverted market means. But a lot of people, when they look at a curve, of a futures curve, where you see the contract months on the x-axis and the y-axis is the price. A lot of people will interpret that as if the front months are higher than the later months, then that means that the market is pricing in lower prices in the future. And that's absolutely backwards. What it's actually doing is saying that we need product now. We don't need you to store it. Give us product. Product is priced higher now than it is in the future. So it's actually a bullish sign. So I think, just for clarity's sake, and honestly, this is something that I struggled with when I was learning commodities as well.
And it is a confusing topic, especially now, because I think the reason why that contract is bid up so much is because of this weather. Mm-hmm. So once that weather breaks in the Northeast, I expect heating oil to fall off some. We've even seen crack spreads on heating oil contract itself jump in the last couple of weeks. I think it will normalize, revert back to the mean when the weather breaks back. So I'm personally a little bearish on heating oil, even though the curve is suggesting a bullish market. It's kind of a confusing time here on that. But as far as crude goes, I think that's the best measure of the curve itself, because it doesn't have that cyclical nature that diesel does.
A little bit less seasonality for heating oil, or than heating oil.
And it's extremely inverted as well.
Yeah. Yeah. And honestly, though, that there's been kind of a differentiation between the crude and refined products market this year. And I think what we've seen is this is almost the reverse of 2022. 2022, we saw diesel pulling up crude, or refined products pulling up crude, because we had this small amount of refining capacity and it wasn't really fitting the need of the great demand that we're seeing globally. But now we're seeing almost artificially high crude oil prices because of OPEC production cuts. And then on the back end, we're not seeing that demand kind of follow through because we have ample refining capacity that we've built out over these years. So I'm kind of with you in that I'm not extremely bullish on refined products as a whole in the near term, or even for the rest of 2025 as the picture stands now. I think where crude is really going to be supported continuously by OPEC production cuts. OPEC has stated that they will bring back barrels after Q1, but they've also said that since the middle of last year. So we kind of know that they're looking for a price, and it kind of sets a floor on crude, which obviously refined products have a similar floor as well, but they're going to be driven a lot more by demand dynamics because that supply has been pretty overwhelming. So really, I think for 2025, we're going to be dependent on how Chinese demand and just global demand overall is, and whether there's any outperformance than what is expected.
Yeah, I absolutely agree. I think, China's definitely remains the catalyst here. I think $65, I mean, just to summarize this a little bit, one thing I just wanted to point out before I summarize is I might have confused folks with saying, or we might have confused them by saying that it's not a good time to do a storage hedge because of the inversion of the market. That is true, but basis values are so weak right now within those two regions, Midwest, Chicago, Group 3, and then also PNW, focus points, and then west of the Rockies in general, weaker basis right now. Those are weak basis markets that inversion doesn't apply. It's not aggressive enough to where it really factors in. And there's a play there we can do with basically put it in the March contract, and we're expecting it to going back into a carry, and then that'll help us with that storage hedge as well. So we're going to strategize around that. And just to let you know, we still think the storage hedge is a very, very strong idea for those two regions, west of the Rockies, Midwest. So just wanted to hone in on that point just so people didn't get too confused. But, going back to the flat price crude, $65 a barrel, I think, like you said, OPEC has kept that floor in place, and they seem to be pretty committed to that. And the big catalyst on where crude prices go north of that, to me, is just China. It really comes down to what they're going to do. Obviously, Trump administration coming in, they could do some things that mix things up. But ultimately, what the Trump administration does to China even is going to be a big piece of what happens next. So it's going to be a real big focus on that for us. And then, watching all the noise behind it and seeing if there's anything that emerges that may change that scope.
Yeah, and I think one thing that we haven't mentioned that maybe gets a little bit more play is either the Russia-Ukraine conflict or just Middle East conflicts between Israel. And I think you and I might brush over these a little bit more than some other talking heads or media outlets. And I think it's because in our minds, I think these conflicts don't really have a direct connection to supply-demand dynamics of the oil market. Yes, there is geopolitical risk that might be elevated, but it all ties back to, in my opinion, Iran, OPEC, and then Chinese demand would be kind of something that's a separate thing. But those conflicts are not going to really change how, Russian crude oil barrels or Iranian crude oil barrels are hitting the market. There's already sanctions on those
exactly.
places, and they're still finding their way to the market.
Unless there's like actual physical attacks or some sort of change in the military aspect of things, that's when I think that things could change on that level, which I will say just there's some reports of Ukraine taking more of an offensive approach on Russia and that could change things. Because I do think Ukrainian, I actually just listened to a podcast with Zelensky and Lex Friedman. And I just wanted to kind of get an idea on where his mind was. And he's really looking to start an offensive measure against Russia and really take it to them and just show a stronger stance, like a backbone from the U.S., the West in general. So if he gets his wish on that, I'm not sure on. I don't really have an opinion on where that goes next, but if they are going to start taking in a more of an offensive approach, I do think they will be looking to attack energy infrastructure because that's kind of how Russia is funding the war, right? So
there were some refineries that were attacked. Those drone attacks have been kind of ongoing, but honestly, it's kind of faded in the background.
No, and I still don't think that changes anything in the short, like in the near term right now. But there's something to keep an eye on, I guess.
Yeah, absolutely. And but that's not for us to really downplay those events as like there still will be, counteractions. There could be counteractions by different parties involved, the U.S., Russia. I mean, those dynamics are still important to pay attention to, especially with the new administration. But in my opinion, at this moment, don't have huge impacts on supply-demand dynamics.
Yeah, I would agree. I mean, as far as like an outlook for energy or for diesel cost, to me, I still remain pretty bearish right now. Currently, where we sit, this is January 9th right now. So just from weather, I mean, it really does come down back to that, circling back on that. Once the weather breaks in the Northeast, I just think that we just actually today surpassed the 200-day moving average, kind of the natural bullish, bearish indicator there. We surpassed it. Whether or not it holds or not remains to be seen. But I do think that at some point, once the weather breaks, we do fall below that, and then it kind of becomes a slippery slope from there. Crude also hit a 200-day moving average on WTI. Whether or not we didn't surpass it either, on the 8th, we actually hit it, and it bounced right back off and actually reverted back down to the 150-day moving average. Today, we've seen a rally, but it's not reaching that point yet. That currently sits around 75.50. So if we break above that, that could cause a little bit more of a rally to come. In my opinion, I think we're going to bounce off of though and go lower.
Yeah, I think Q1's definitely going to be our higher point of the year. I think the timing obviously is difficult. So when you say that bearish for the rest, or you're somewhat bearish, I think I'm interpreting that as kind of the rest of 2025, correct? Not, tomorrow or the next day.
I think it's hard to say as far as like we're going to see some bounciness from now until the end of the year. I mean, with the new administration, there's going to be a lot of, especially with the Trump administration, there's more volatility within just some tweets that he's sending out than sometimes than anything else. But I think that if we get inside of $70 a barrel, though, I do think that's a good time to start looking at contracting if you are a buyer of forward contracts. To me, that's a good zone to get in. I don't see a lot of significant downside, but I do think we'll start seeing these knee-jerk reactions to whatever the administration's saying or maybe some China news that comes out as far as demand goes, and then you start seeing higher prices from there. But I'm with you. I think that 2025 is going to remain in the lower 70s, and I don't think that the average of the year is going to bounce above that too much.
Yeah. I think I'm with you. I agree that it's probably going to be kind of more of the same of what we saw last year. I think one myth that needs to be dispelled and needs to be discussed about with the new administration is that we've heard this many times is the drill, baby, drill. Yeah. And that just needs to go to rest because President Trump can only do so much with regards to, and any administration, not just Trump,
right,
can only do so much with regards to how much oil the U.S. is going to pump. So I think we're still going to see some growth in production, but it's going to be somewhat constrained. We saw 23 to 24 crude oil growth was almost a third of what it was from 22 to 23. So I think we're still going to have kind of a lower amount of growth in 2025. We will see increased production, but that rate of increases is just not going to be as substantial, especially with the price environment that we're in. Unless we were at $100 per barrel, that's when you drill, baby, drill. But
right. I think oil infrastructure or energy infrastructure in general, that will be the thing that changes maybe the most. Pipelines, things like that get approved. And those things won't probably happen until 2026 at least, if not longer, So no immediate reaction. And I think, again, that $65 a barrel is a good floor because U.S. producers rely on that as well. It's not just OPEC that wants that. So those guys aren't going to get hyper aggressive by any means with crude at that level because that would just be a death wish to them.
Yeah. And I think after reading a lot of their earnings reports, they're all kind of echoing similar sentiment as just returning cash flow to investors. They're not all talking about expanding CapEx or anything like that. So right. I think we've entered this time where perhaps the drillers and producer companies are just becoming more, I guess, disciplined. And that's kind of their focus.
I don't know if you watched Landman on Paramount, but Billy Bob has a good quote there. He says, everybody seems to be happy with crude being around $78 a barrel. Consumers are happy. Producers are happy at that level. And that really holds a lot. I mean, that's true. They did some good research because that was actually, I really think that's a perfect number for everybody would be pretty content with that level, Just keep that in mind. I think producers are aiming for that as well globally. It's not just US or OPEC, it's both. So think about that.
There's definitely a sweet spot. And speaking of sweet spots, we're going to move on to talking about food, which is, one of my favorite parts of every day. Trevor knows this all too well. He just recently came back from Italy. And so now he deems himself an Italian food expert. So we're going to discuss Italian food in Kansas City.
Yeah, I still have to point at the menu. I can't still pronounce any of the menu items they have, but I'm pointing to the waiter or waitress and they're just ordering it for me. Yeah. But hey, I can definitely evaluate the taste.
Yeah, that's American right there.
That's right. We're one language, okay? That's all I know, English. Yeah, I realized really quick Italians know they probably know 3 languages better than I know 1.
Yeah.
So
we can say that about a lot of places, sadly.
Yeah.
But so Italian restaurants, Kansas City. What do you think? We discussed this a little bit earlier, but speak on Bella Napoli. That's one spot that I think you've just recently found out.
Yeah, it's so good, and it's very authentic. Way more than other places in Kansas. Kansas City actually has, just for some history, has a really rich Italian history in general. So we have some great Italian restaurants. That does not mean our pizza is good. Our pizza is
surprisingly so. I don't know
like
why.
One of the things I can knock on Kansas City. There's some good spots, don't get me wrong, but for some reason there's not overall just like a bunch of good restaurants that are considering our Italian presence here, and the old mob used to be here, So we have some really good spots though, and Grozzo's is one of my favorite spots. Mergazzo was one of them as well. But then I went to Bellinapoli and my mind was blown. I literally felt like I was in Italy. Maybe the most authentic place I've been in Kansas City in general, just overall. I mean, I looked out the window there and I was like, is this Italy?
And then you saw the snow on the ground and you said, no,
I didn't hear.
It's not.
Hey, there's snow there.
Yeah, I guess wrong. It's not where you were though.
No, not at all. But no, it's amazing. Their pasta, my wife got some...
Amatriciana.
There you go. See,
I believe.
Apparently he can pronounce it, but I can't.
I don't know if that's right.
My dish was great too, and I don't even remember what the name of it was. But overall, great place. If you come to Kansas City, I highly recommend it. What's your favorite spot, though? Italian-wise.
My wife's favorite spot is probably Bellinapoli as well. So one spot that we go to is Johnny Cascone's, and that's just like kind of one of those same just classic spots. It might not be like super, super upscale or anything like that, but the meatballs there are incredible. I get that. I'm kind of between that and chicken spadini every time I go there. And then this is not my favorite Italian spot in Kansas City, but the other day, this week, we got Italian from the Car Wash Italian. Can't think of the name.
Dominic's.
So it's an Italian spot that has a car wash attached to it. And it is delicious. I got a chicken spadini sandwich from there.
Great.
And, I was happy, fat and happy for the rest of the day.
Spot. That's a great spot. It's like the quick version of Grozzo's.
Yes, exactly. And chicken spadini actually has Kansas City origin. So that's a chicken dish. They've got breadcrumbs, garlic, lemony. It's delicious.
It's awesome.
Stuff with some cheese. But, I mean, now it's, only 3:00 today, but I'm getting hungry for supper as we speak.
Yeah, you eat dinner at 4:00. You're officially a dad.
Yeah. So I think that kind of concludes what we're wanted to discuss today. I think the biggest thing we wanted to get across is just what the new administration means to the oil market. There's still going to be a little bit more change and kind of price discovery, especially going forward, and how these dynamics unfold is still up for debate. But I think there's somewhat of a grasp as to kind of how Trump might respond to certain things. But really, until we see the supply and demand dynamics, we won't know where everything is. But ultimately, we're seeing prices up a little bit. I think we're going to be set for a sideways market. But really, if you want to see what I think of the market and what our team has kind of put together, we are doing an Outlook free webinar that I am doing an outlook for 2025. It's on January 21st from 2 p.m. to 2:30 p.m. Central. And a link to sign up to this will be in the show notes. I'd love to see you all on there. And we're putting together a research paper that goes along with that. So please do attend, and any feedback would be greatly appreciated. Thank you, everybody, for attending.
Thanks, guys.
You've been listening to the Focus on Fuels podcast with Trevor McClanahan and Alex Hodes, brought to you by StoneX, NASDAQ ticker SNEX, a global Fortune 100 financial services company with a century of commodities risk management experience. Subscribe to Focus on Fuels on your preferred podcasting platform. For insights on managing fuel and energy price volatility, and to sign up for the free StoneX Morning Energy Brief newsletter, email focusonfuels@stonex.com or visit www.stonex.com. Please feel free to rate, review, and share this episode with colleagues. Until next time.